Hi, good morning to Puan Haida and my friends. Today we will present about auditing current liabilities. And my name is Nufita Hidayah binti Muhammad Ismadi, and my team name is Nur Fazana binti Muhammad Radi. So for 5.1, discuss the nature of current liabilities. The definition is the under MFRS 101 presentation of financial statement. A current liability is a present obligation arising from past event that an entity expects to settle within its normal operating cycle or within 12 months after the reporting period. For the example of current liabilities is account payable or trade payable, and accrued expenses, income tax payable, short-term borrowings, bank overdraft, and unearned revenue. For 5.2, provide appropriate audit assertions and accounting treatment. Audit assertion. Auditors check that current liabilities are recorded correctly using this assertion. First is existent. Liabilities recorded actually exist. Second is completeness. All liabilities that should be recorded are included. Third, accuracy or valuation. Amounts of liabilities are recorded correctly. Fourth is cut off. Liabilities are recorded in the correct accounting period. Next is classification. Liabilities are classified correctly as current. Lastly is presentation and disclosure. Liabilities are adequately disclosed in financial statement. So for the next is accounting treatment. First is recognition. Recognize liabilities when the entity has a present obligations from past event. Second is measurement. Trade payables and short-term loans is amortized cost. Next is accrued expenses, best estimate of obligation. So third is classification. Current if due within 12 months or within normal operating cycle under MFRS 101. Lastly is disclosure. Provide adequate notes including nature, amount, and settlement term.
Now I will explain about the accounting system and control activity, especially for a current liability. A good accounting system in the purchase to pay cycle start with a purchase request and approval. After that, the company issue a purchase order. When a goods are received, they are recorded and the supplier invoice is also received. The accounts payable is recorded, followed by a payment approval and the payment processing. To ensure everything is accurate, strong control activity are needed. First of all, a purchase and invoice must be approved. Second, there must be a segregation of duty, which means different people handling ordering, receiving, and paying. Third, document like a purchase order and receivable note must be matched. Lastly, the company should receive supplier balance and outstanding payables regularly. This control helps prevent error and fraud and ensure liability are recorded correctly. For this slide, I will explain audit procedure related to the assistant assertion. The purpose of assistant is to confirm that the liability recorded are real and actually exist. To do this, auditor will inspect supplier invoice and supporting documents. They will also review a supplier statement or confirmations if needed. Example of evidence include a supplier invoice and vendor statements. These documents help auditor verify that the amounts recorded in account payable are accurate and valid. In conclusion, this auditor procedure ensure that the company does not record a fake or incorrect liabilities.
For B, completeness, audit procedure is search for unrecorded liabilities. Auditor tests completeness by checking if any liabilities exist at year end but were not recorded. A common method is select payment made after year end. Next is inspect invoices and document to see whether the liability existed before year end. So for the evidence example is first we have subsequent payment listing, supporting supplier invoices, and receiving reports. Next we have C, valuation. To confirm liabilities are correct in amount, recalculate invoices amount like tax or totals, and check correctness of balance and postings. For the evidence example, we have payable journal, cash disbursement journal, and risk period testing.
For this slide, I will explain about cut-off. Cut-off is important to ensure that all transactions are recorded in the correct accounting period, especially around the year end. To test this, auditor will examine transactions that occur near the end of the financial year. They will check whether these transactions are recorded in the correct period. Auditor will also match the invoice date and good receipt date with the recording date in the system. I show you that the picture of example evidence include invoice and contract, board meeting minutes, and purchase order. This process help ensure that there are no transactions recorded in the wrong period. Lastly, I will explain classification and presentation. This is to ensure that liabilities are properly classified between current and non-current liability. Auditor will review loan term and repayment schedule to understand when the liabilities are due. They will also confirm that liabilities due within 12 months are classified as current liability. This is a picture example of evidence include unentered invoice file, accounts payable listing, and vendor statement. This ensures that the financial statements are presented accurately and clearly. For the conclusion, current liabilities are important obligations that must be settled within a short period. Proper recognition, measurement, and classification under MFRS 101 ensure accurate financial reporting. Auditor play a key role by checking assertion like completeness and accuracy, supported by a strong accounting system and internal control to prevent error and fraud. That's all for us. Thank you for listening to our presentation.